Hey everyone, welcome to today's Explainer. Today, we're diving into one of the absolute most fascinating ways to tap into international long-term growth potential. We're talking about the iShares MSCI All Country Asia ex-Japan ETF, or as most people call it, AAXJ. If you've been trying to figure out how to get exposure to the raw, industrial, and technological engine of the Eastern Hemisphere, well, you're in exactly the right place. We're going to pop the hood, look at the mechanics, the massive tech companies involved, and the unique regional dynamics that really drive this fund.
So, here's our roadmap. First, we'll cover what AAXJ actually is. Second, we'll look at the tech heavyweights involved. Third, the regional growth drivers. Fourth, navigating cyclical risks. And finally, we'll wrap up by looking at the long-term horizon.
All right, part one. What exactly is AXJ? Well, the fundamental strategy is right there in the name, Asia ex-Japan. This is a highly targeted allocation tracking 10 different developed and emerging equity markets. We're talking heavy hitters like China, Taiwan, South Korea, and India, plus places like Hong Kong, Indonesia, Malaysia, the Philippines, Singapore, and Thailand. But notice the big omission. It deliberately cuts out Japan, and there's a good reason for that. By carving Japan out of the equation, you're getting a pure, unfiltered dose of the emerging and developed markets that act as the true manufacturing engines of the region.
And let me tell you, this strategy has attracted some serious capital. The fund boasts a massive footprint of roughly $4 billion in total assets. That kind of scale gives AXJ incredible liquidity in the global market. Think about it. Investors are parking $4 billion here specifically to capture that massive long-term growth potential we're talking about today.
Now, this ETF is issued by BlackRock under their iShares brand, and it's actually been around for quite a while, since August of 2008 to be exact. To get this specific basket of 10 international markets, you're looking at a gross expense ratio of 0.72%. Basically, that's the cost of admission for getting a convenient single-ticker solution to a wildly complex, globally significant supply chain.
Okay, moving on to part two, the tech heavyweights.
What is truly wild here is the sheer dominance of one single sector. Information technology makes up a staggering 50.5% of this entire portfolio. Financials follow way behind at 16.2%, and then consumer discretionary and industrial sit at roughly 7.5% each. But you literally can't ignore that 50% tech weighting. Because of it, when you invest in AAXJ, you're effectively buying a leveraged play on the global semiconductor cycle and Asian interactive media. You really aren't just buying stocks here. You're buying the global plumbing of the digital age. You've got TSMC, the absolute undisputed king of making microchips, taking up roughly 17% all by itself. Then you throw in South Korean giants like Samsung Electronics and SK Hynix, and follow that up with massive Chinese internet conglomerates like Tencent and Alibaba. The whole shebang is heavily reliant on just a few massive Asian chipmakers and tech powerhouses.
But here's the catch. This structure introduces a pretty heavy concentration risk. Just the top 10 holdings alone command over 42% of the fund's total assets. To put that in perspective, the category average is usually around 45, so it's a very top-heavy fund. If you hold AAXJ, your portfolio's fortunes are completely, inextricably linked to the success or failure of these specific megacap companies. Basically, if the global semiconductor supply chain sneezes, this fund catches a cold.
Let's dive into part three, regional growth drivers.
So, what's actually fueling these companies? Well, according to BlackRock's own shareholder report, the fund's recent performance has been driven by a very distinct set of macro factors. They explicitly noted that equities were, quote, supported by surging demand for artificial intelligence chips and continued innovation and historic stimulus efforts. What we're seeing is a massive two-pronged growth engine. You have explosive global demand for AI tech on one side and highly localized government interventions trying to boost the broader economy on the other. And you know, these drivers really feed into each other. You have TSMC physically building the chips to supply the global AI boom. Then, that massive computing power fuels Alibaba's huge cloud computing expansion and Tencent's interactive gaming units. And underneath all of this cutting-edge tech infrastructure, you've got massive capital injections from the government propping up large Chinese banks in the financial sector. These interconnected catalysts are exactly what give this ETF its massive long-term growth runway.
Now, let's flip the coin for part four, navigating cyclical risks. When we look at the inherent volatility of this asset class, it's actually a fascinating split. On the defensive side, we see some real resilience. Recently, the fund has shown a strong trailing 3-year downside capture ratio of 93, which simply means it captured less of the market's downside than its benchmark. In late 2023, its drops were actually shallower than its peers. But historically, Well, it has suffered some severe cyclical drawdowns, including a punishing 5-year maximum drawdown of negative 40.1%. During extended stress windows, it can and has suffered steep, multi-year underperformance.
Honestly, the cyclical extremes here are almost staggering. In its worst 3-month period, the fund dropped 18.37%. But in its best 3-month stretch, it surged 27.72%. That is the textbook definition of a roller coaster, so keep your hands and feet inside the vehicle at all times, right? When you blend emerging and developed Asian equities, especially with that massive tech weighting we talked about, you are absolutely signing up for these kinds of extreme price swings.
So where exactly does that roller coaster come from? It's really a domino effect. Tariff tensions and shifting global trade policies disrupt raw material and commodity cycles, which countries like Australia and Taiwan deeply rely on. Add in the fact that unhedged emerging market currencies fluctuate wildly against the US dollar, and you get these abrupt drags on your returns. And finally, because the ETF trades in the US while the underlying Asian exchanges are fast asleep, it frequently prices intraday on stale local marks, which causes temporary pricing dislocations.
All right, bringing it all home with Part 5, the long-term horizon.
This is really where the whole story comes together. Because despite the severe short-term risks and macro turbulence we just talked about, the long-term potential of this engine room remains entirely intact. Looking at historical market returns, the fund posted a massive 1-year return of 46.7%. Now, the 5-year annualized return smoothed out to a much more modest 6.9% because of those cyclical drawdowns we mentioned. But stretch it out to a 10-year horizon, and the fund has historically delivered a very solid 10.1% annualized return. That perfectly illustrates how staying committed in the market can smooth out those extreme cyclical bumps and really unlock the true long-term growth potential of the Asian tech sector.
And the broader industry recognizes this balance. Morningstar awards AAXJ an overall 3-star rating based on its risk-adjusted historical returns against roughly 36 Pacific and Asia ex-Japan stock funds. Now, a middle-of-the-pack rating might not sound flashy, but it's actually a great confirmation. It means AAXJ effectively delivers its intended, highly specific regional exposure without unnecessarily amplifying the baseline volatility that already exists in this aggressive category. Essentially, it does exactly what it's designed to do.
So, if we distill all of this down into one big takeaway, AAXJ is the engine room. It is a highly targeted, leveraged play on raw material demand and the global technology supply chain. It's purpose-built around the Asian consumer and semiconductor markets, intentionally leaving Japan out of the mix to hyper-concentrate that exposure.
Which leaves us with the ultimate question for you to consider as an investor. Understanding the heavy concentration in megacaps like TSMC and Tencent, and knowing the real macro risks involving tariffs and fluctuating currencies, can your portfolio stomach the inevitable short-term cyclical turbulence in order to capture the massive long-term growth of Asia's tech engine? Ultimately, it's a question of your own personal risk tolerance and your investment time horizon. Thanks so much for joining me for this explainer on AAXJ. Keep learning and stay focused out there.